Okay, welcome to the deep dive. This week, well, we're looking beyond the immediate chaos, aren't we? Last week was rough. A huge $19 billion liquidation event.
Absolutely jarring. The noise was just incredible, but the immediate storm seems to have passed.
Right. So our mission today is really to sift through all that, the aftermath and figure out what's really happening underneath.
Hmm.
What are the actual institutional and tech trends defining this recovery phase?
That's the key question. Because there's a real paradox playing out this week, isn't there? We need to get a handle on the structural strength versus the fear that's clearly still lingering.
Okay, let's tackle that tension head on. The positive side, the big headline really, is Bitcoin. It held that crucial $110,000 level. That was huge.
Massive defense. Analysts are saying, that this shows the market basically absorbed that massive shockwave.
And it's consolidating now, maybe, just maybe, suggesting some institutional buyers are looking at it again, thinking it's safe to step back in.
Well, that's the surface reading, the price action. But if you peek under the hood, that institutional fear is still very much alive. Look at the spot Bitcoin ETFs.
Ah, right. What happened there?
Despite Bitcoin holding steady, those ETFs, the main way Wall Street gets exposure, saw $1.2 billion in outflows just this past week.
Wow. $1.2 billion. That's significant. How does that stack up historically?
It's the second largest weekly outflow since they launched earlier this year. So yeah, pretty major.
So the price holds, which feels strong, but $1 billion plus heading for the exits. That signals institutions are still de-risking, right? Risk off is the mandate.
Exactly. You've got these two realities clashing. Price stability at $110K that shows real organic demand, resilience. But then, bam, this huge capital flight showing that, high volatility still trips those circuit breakers at the big firms. Short-term risk protocols kick in hard.
So to really understand what's next, we need to look beyond just the price ticker.
We absolutely do. We need to look at how TradFi is actually building the pipes, the regulated plumbing, to connect with Web3, and also the big shifts happening in global policy around accepting these assets.
Okay, let's stick with that market structure for a moment. Defending $110 is psychologically important, no doubt, but that $1.2 billion rushing out, what does it tell us? Is it just short-term jitters, or are institutions rethinking their whole crypto thesis?
I think it's primarily short-term risk management. What's really telling is the speed of that outflow. $1.2 billion doesn't just dribble out. That sounds like a reflexive, almost automated reaction.
Like volatility hits a certain point and the algorithms or the compliance rules just force them to sell.
Precisely. The trading desk might believe in Bitcoin long-term, but their mandate, their compliance framework, forces them to cut exposure when volatility spikes like that. It's less about the asset's future and more about immediate portfolio rules.
So how should you, our listener, make sense of this? Managed money flees the asset itself, the liquid Bitcoin and the ETF. But we also know these same institutions are pouring money into building crypto infrastructure, their own desks.
Yeah, it seems contradictory, but the key is to separate the two things. Volatility pushes money out of the easily traded asset temporarily, but it absolutely does not stop the investment in the underlying tech and infrastructure.
So they lighten the load on the books for now.
Exactly. But they're doubling down on building the railroads, the systems that will run on this technology long term. They almost see this volatility as, well, maybe even an opportunity to build while everyone else is panicking about the price.
Okay, let's talk about those railroads then, because there were some really big signals this week suggesting that institutional commitment is, if anything, deepening. I'm thinking about that S&P Global Ratings and Chainlink news. That sounds major.
Oh, it's monumental, especially for building trust and meeting compliance demands. S&P, the gold standard in credit ratings, is going to deliver its stablecoin stability assessments, their SSAs, directly onto the blockchain using Chainlink.
Right, SSAs tell you how safe a stablecoin supposedly is, we know that. But why is putting them on chain suddenly such a big deal? What changed? Is there a regulatory push here?
There is. The big catalyst is the Genius Act. It's complex, but the core of it demands much clearer, more frequent, and importantly, verifiable reporting for major stablecoins used in the U.S. financial system.
Okay, so institutions need solid proof that the stablecoins they might use are actually stable and meet these new rules.
Exactly. And an SSA delivered on-chain via a decentralized oracle like Chainlink that gives them real-time, tamper-proof, instantly auditable data. It's cryptographic proof of stability and reserve backing.
So it moves compliance checks from like a quarterly PDF report
To a live, verifiable feed. It's precisely the kind of robust, trustworthy data Wall Street needs to satisfy regulators and deploy really serious capital into the space responsibly. It's a game changer for compliance.
That really does sound like serious grown-up infrastructure.
Yeah.
But it's not just about assessing stablecoins, right? There was also news about getting Bitcoin itself onto corporate balance sheets more easily. TAP Global Group.
Yeah, TAP Global launched something called Bitcoin Treasury-as-a-Service, or BTAS. It tackles a very specific, very tricky institutional problem.
BTAC. Okay. Sounds a bit jargony. Is it just fancy custody? Don't prime brokers already handle Bitcoin custody for companies? What makes this different?
That's a fair question, but BTAS aims to be much more than just holding the keys. If you're a publicly listed company, putting Bitcoin on your balance sheet creates massive headaches.
How so?
Think about accounting standards, GAAP, IFRS. They weren't designed for Bitcoin. Then there's specialized risk reporting for shareholders, for the board. It's complicated.
So BTAS tries to solve all that.
Exactly. It packages everything together. The custody, yes, but also the specialized financial reporting outputs, the audit trails, the policy controls, all designed to meet the very strict requirements of corporate governance for public companies.
Okay, so it's the regulatory and accounting layer wrapped around the custody. That makes it truly ready for, maybe, the next wave of companies looking at Bitcoin as a reserve asset.
That's the idea. It's maturing infrastructure designed specifically to make it easier for corporates to adopt Bitcoin, not just as speculation, but as a potential inflation hedge or long-term treasury asset.
Interesting. And speaking of rotations, during market consolidation, we often see the smart money looking for the next big growth area. Grayscale filing for a Bittensor? TAO. Trust certainly caught my eye. That's crypto meets AI, right?
Yes, and this is really significant. It shows where regulated investment products are heading. TAO, the Bittensor token, is all about decentralized AI infrastructure.
Decentralized AI infrastructure.
Yeah.
What does that actually mean?
It's a network that basically pays people or machines to contribute to AI, things like creating models, training them, sharing data, providing computing power. Grayscale setting up a trust means Wall Street wants regulated exposure to the fundamental rails that AI might run on in the future.
Not just the AI applications we use, but the underlying network itself. Why the focus on decentralized AI, though?
Well, it potentially tackles some huge issues in traditional AI, mainly around data control, privacy, and censorship. Decentralized networks like Bittensor could allow for more open innovation and fairer rewards for contributing data or compute. Grayscale is essentially betting that AI's future architecture might look more like crypto's, decentralized and community-driven.
Fascinating intersection. Okay, all this building is great, but it needs stable ground, right?
Yeah.
The regulatory landscape has to support it. Let's shift gears and talk about regulation. Those XRP ETF deadlines were last week. What happened?
Right. October 18th to the 20th were key dates for the SEC regarding several XRP ETF filings, including big names like Grayscale and Bitwise. This is potentially a landmark moment for XRP.
If they get approved, what would that signify? After all the legal battles.
It would be huge. It could finally provide some clarity on XRP's regulatory status in the U.S., which has been debated for years. Approval would essentially greenlight it for institutional investment via these regulated ETFs, potentially boosting its role significantly within the U.S. financial system.
And it's not just federal action. We're seeing moves at the state level, too. Florida introduced House Bill 183. What's that about?
HB 183 in Florida is pretty bold, actually. If it passes, it would authorize the state's chief financial officer to invest up to 10% of certain public funds directly into Bitcoin and crypto ETFs.
10% of public money. Wow. That's not just dipping a toe in.
Not at all. This is serious treasury management, considering crypto ETFs as a legitimate investment category for public funds. It's a big signal.
And this follows California making moves, too. Although, didn't California opt to hold crypto directly rather than via ETFs?
That's right. California's approach was holding the actual crypto. Florida is focusing on the regulated ETF wrapper. Both moves, though, show major states starting to view these assets as more than just speculative novelties. They're being considered as potential reserve assets.
A quiet but powerful vote of confidence from state governments. We should balance this, though. Is everyone rushing in? What about globally?
Good point. It's definitely not a uniform picture. We're getting reports from Asia, specifically China, taking a more cautious stance.
How so?
Beijing seems to be moving to prevent major Chinese tech firms from issuing or using stablecoins, even in Hong Kong, which has been positioning itself as a crypto hub. It shows continued concern, particularly around a currency control and financial stability from China's perspective.
So a reminder that while things might be opening up in the U.S., Regulatory approaches still vary a lot globally. Acceptance is patchy.
Definitely. It's a crucial piece of context.
Okay, let's pivot back to the tech itself. Because despite all the market jitters and the regulatory back and forth we just discussed, the pace of innovation in the decentralized world just seems relentless. Look at Uniswap expanding to Solana.
Yeah, that's a great example of breaking down walls.
Yeah.
Uniswap is, the king of DX aggregators, primarily rooted in the Ethereum ecosystem, the EVM world. Solana is a totally different beast, different architecture, different virtual machine.
So this isn't just adding another coin people can trade. This is a significant technical integration, bridging two separate universes.
It really is. It improves choice and liquidity for users, sure. But technically, it shows that the biggest DeFi protocols are investing heavily in becoming truly cross-chain, connecting these high-speed layer ones even if they're fundamentally different. The drive for interoperability is clearly accelerating, regardless of market conditions.
And we saw something similar with proven DeFi protocols spreading onto new networks. Kraken's Layer 2, Ink, deployed Hydro.
Exactly. Hydro is essentially a white label version of a AV v3. AV is arguably the most trusted, most battle-tested lending protocol in all of DeFi.
What does white label instance mean, practically? Like they just copied the code.
It means the core AV v3 code, which is audited and secure, is designed to be modular and easily deployable onto new chains. Ink is a specific layer 2, incubated by Kraken, but the real significance is how quickly this sophisticated financial infrastructure, AV, can be spun up on these new specialized networks.
So developers can basically take this proven lending engine and deploy it rapidly wherever needed, perhaps for specific institutional use cases on a dedicated L2.
Precisely. It demonstrates incredible efficiency in technological development. Complex, secure financial tools are being deployed rapidly, tailored for specific needs. That underlying momentum is powerful and seems completely unfazed by short-term market noise.
Okay, so let's try to wrap this all up. When we synthesize the week, it's quite a story. We started with that $1.2 billion panic outflow from ETFs.
Short-term fear, definitely visible.
But the week also saw really foundational building blocks being laid. S&P putting compliance data on-chain, specialized services like BTIS emerging for corporations, major DeFi players like Uniswap bridging to completely different ecosystems like Solana.
And proven tech like Alav proliferating onto new layer 2s. That's the core story, I think. Yes, the market held $110K, showing resilience, but the real action is the acceleration in building the next generation of infrastructure.
So the smart money isn't necessarily running away.
It doesn't look like it. It looks like it's rotating towards things with more certainty. Regulated infrastructure, compliant solutions, deep tech, like decentralized AI. They're building the heavy-duty, regulated plumbing needed before the next big wave of capital can potentially flow in.
So the message for you, the listener, seems to be maybe pay less attention to the immediate reflexive fear in the market.
And more attention to the foundational structures being built and solidified right now. The groundwork for broader adoption is being laid, piece by piece.
Okay, the final thought to leave everyone with.
Yeah, think about the combined implications of Florida's HB 183 and that S&P Global partnership using Chainlink. You have state governments potentially managing public funds via crypto ETFs, and the world's leading rating agencies providing real-time risk data on-chain. What happens when governments and global finance giants stop seeing these assets merely as speculative commodities?
And start seeing them as essential digital infrastructure,
Right.
required infrastructure.
Exactly. That shifting perspective from speculative asset to essential infrastructure is profound. I'd really encourage you to maybe look up the actual legislative text of Florida's House Bill 183, see how they're starting to formally frame this asset class in law, that legal and conceptual shift. That might be the biggest story unfolding right now.